I would say it's been a roller coaster of a month, but that doesn't really capture it, does it? Can anyone remember a more consistently volatile period for global markets? The threat of an outright collapse into recession, not yet quite chased away, followed by one of the fastest US market rallies ever. How should investors steady themselves? And what's next? Well, this month we consult the oracles, Fidelity's chief investment officers for equities and fixed income. Hello, I'm Seb Morton-Clark, and this is Fidelity Answers, the investment podcast where you hear directly from the people working at the coalface of markets. And this month, does the threat of a recession mean I should cut risk now? Or maybe there are underlying trends that we should be more focused on? Well, I'm very pleased that to help me with those questions, I'm joined by two of the leaders of Fidelity's investment operations, Niamh Brodie-Matura, CIO for equities, and Mariam Lemohadek, CIO for fixed income. Niamh and Mariam, a very warm welcome to you both.
Hello.
Hello.
Well, to get started, I have a quick-fire question for you both. If there's one word you'd use to describe the mood of the investors that you've been talking to over the past month or so, what would that be? Niamh, if I start with you.
Frenetic.
Frenetic, okay.
Intense.
Intense. Yes, I think those both describe well what's been going on, and there's no denying the challenges that are at hand. Mariam, does what we've been going through over the last couple of months, does that change what you're doing on a day-to-day basis at all?
It doesn't, but it actually means that you need to have more scrutiny and a closer oversight on, the portfolio manager's activity. I think all of us, we've experienced different crises, so we're a bit tempted to think, well, what does this one remind me of other crises? And there are commonalities, right? So I think we've all learned some lessons from previous crises. And I think, it doesn't change the way we operate. It just means that it is very intense.
Absolutely. And Niamh, you oversee a broad range of strategies, of course, with the portfolio manager cohort that you run. From them, what has good looked like to you over the last couple of months?
Let's go to the market environment that we've had, and I think that will help in terms of answering the question. So why did Mariam say intense? Why did I say frenetic? The market has been more volatile. We've seen VIX, which is the volatility index, go from 15 to a high of 30 during March. We've seen oil prices gapping $5, $10 from day to day. We've seen percent moves in indices rather than basis points indices. So, clearly it's been an energetic time. We've had an awful lot of noise in the market, an awful lot of updates. We're heading into earnings now on top of everything that's happening from the geopolitical side. So it's been busy. There has been an awful lot of noise. There is always signal, but an awful lot of noise. And part of what we need to do is separate that signal from the noise. We're always focused first on the client outcomes, and the structure that we have is set up to deliver in the best possible way in terms of those client outcomes. So the portfolio managers are remembering, what is the outcome that their clients expect, what is the process that has been guided for, and then evaluating, reevaluating with input from oversight from risk management to try to see if the stocks that they own, the positioning that they have is optimal at every point. The interesting point about volatility, clearly it has implications in terms of risk. It means that the overall assets under management as well as the individual portfolios are moving really quickly from day to day. It can create opportunity as well, though, which is interesting.
And actually, on that mispricing question, where are your portfolio managers seeing that most?
This is a really big topic, Seb. Because of the really important implications of what's happening right now for the long term. And there are two huge structural changes potentially underway. The first is on the energy and broader supply chain side, and the second is on the AI side. What our portfolio managers and what our research team are particularly expert in is bringing together not just the macro understanding, not just understanding what's going on from a geopolitical perspective, but really knowing what's happening with industries and with companies. Right now, what's particularly of interest is supply chains, because the turmoil, the disruption, the potential change is greatest there. And that means you can have the biggest earnings surprise, frankly, and therefore the mispricing often comes from earnings surprise. One super interesting point as I was looking through the valuations of the different markets at the moment, US is a little bit elevated relative to history, but a number of the markets are exactly bang on the PE multiples, the price earnings multiple, the long-term gauge of valuations compared to where they have been historically. So we think the opportunity and the mispricing is much more about getting the earnings right, the expectations of earnings, the resilience of earnings, and that's where they're looking for opportunity.
Great. We're going to come back to some of that shortly. Just to come back to you, Marion, on the fixed income side, thinking again about what the portfolio managers that you run, what they've been doing, what good looks like. How have you been advising them? What have you been impressed by?
I think in those times, it's really, really important to ensure that you have a healthy debate within the team, and to ensure as well that you give enough comfort to portfolio managers to reflect on what's happening in the markets and to take actions. You don't want them to trade all over the place, right? So I was actually really, really pleased to see a lot of really thoughtful discussions. Really portfolio managers sharing like their thoughts, traders as well, sharing what they know about the liquidity, some developments as well. One of the example was that there was a steepening trade, which was really a crowded trade within the market, which was really kind of very quickly unwound, which explains some of the moves that we've seen on the short end of the curve in particular. So, traders as well contributing to discussions about the market developments, analysts, of course. I think you really need to ensure that you have those healthy debates. You really want to, with some of the support teams that we have, the portfolio construction and risk team in particular, we want to go and see each of the PMs individually to challenge the level of risks they have, for them to assess whether they want to increase some positions or to take profits of some of the positions, like namely, we entered long inflation break-evens into the month of March, which was a really good trade to have in those portfolios. But the key question is, when do you think that you need to either add risk to your portfolios or, on the opposite, actually take some profits? So this is exactly the type of environment you need to ensure. And I think it's really good to be in the office, at the desk, to have all those discussions, ongoing discussions. Because you don't want to be trapped into the headline comments. You also don't want to trade too much. So you want to take the right actions for the portfolios and for the clients ultimately.
Excellent. Okay, so really is a message of rolling with the punches, but making sure that those debates are taking place. Because, as you say, Marion, whatever the headlines are telling us on a daily basis, there's actually no guarantee of what it actually means for the ease of shipping through the Strait of Hormuz and oil, gas or fertilizer supplies for the months ahead, all of which are going to be crucial for global growth. So, on that, Marion, how close do you think we are to a slide to stagflation or recession, those aspects that markets have been worrying about recently?
This is a key question. A little early to have really precise answers, but clearly this is what the fixed income markets has been reacting to, those fears. And, we've had significant sell-off on the short end of the curve. We've had also significant widening of inflation swaps, the one-year inflation swaps, extremely correlated to oil prices. So what does that tell us? It tells us that very quickly fixed income markets have been expecting much more of a stagflation environment. We're definitely not there yet, but there were also some fears at some stage, like are we heading into recession? So I think those were, and still are, the two big questions for fixed income markets. And it's fair to say that, any energy shocks are leading to higher inflation. We know that there are very quick spillovers on food inflation and higher inflation expectations from energy prices. And, also we are reducing the outlook on growth. If you look at what the OECD has been doing, they've been actually reducing the growth outlook and increasing the inflation outlook. And this week is going to be quite interesting as well, because we'll have the PMIs for April. And if you look at the consensus and the expectations in the market, it's clearly for a significant reduction of the activity. So those questions will be quite critical for the next few months. And the longer that conflict lasts, the higher those risks are going to materialize in a way or another.
And so is this making you more cautious on duration, for example?
This is definitely very tricky on duration. You need to be as active as ever, I would say, on duration. I think it favors at the moment the very short end of the curve, the 2 to 5 year part of the curve. The longer end of the curve is definitely much more at risk of, what is likely to happen on budget deficits from the governments. But clearly, you need to manage very cautiously and very actively that short end of the duration of the curve and duration exposures.
And do you think that central banks are more or less taking the right stance?
It's been really, really interesting to see the developments of central banks' expectations and the different pricings that we've had in the market. We've had 1 week literally in March, middle of March, where market expectations went from central banks cutting rates to central banks hiking rates, which is, I've been in fixed income markets for more than 25 years, never experienced that quickly. What we're seeing at the moment is they're very cautious in their declarations. They don't want to be in a rush. They're also really mindful that, 2022, like the ECB hiked in July, the shock started at the end of February in 2022. So they don't want to be late if they have to face a significant higher inflation profile. The Fed has a dual mandate, not only about inflation, but it's also about growth. So it also changes a little bit, the focus, plus we have a change of chair at the Fed. So what I find is at the moment, we have markets is pricing a much more, I would say, rational central bank outlook than what we had a few weeks ago.
Niamh, thinking about markets a bit more, what are you perceiving that they're missing at the moment? And what are the scenarios maybe that you're envisaging from here?
First, let's talk about what the market is getting right. I think the market is right to adjust in price for a very short-term geopolitical conflict by looking through it and looking through the volatility. But that's why Marianne's answer on the duration is a really critical one. The longer the conflict goes on, the longer the second order, third order effects start to kick in. And also, frankly, the longer the actual physical disruption starts to make it more difficult to bring back the supply of energy. But in terms of what the market is missing, in Fidelity, we tend to look long term. We're thinking about our clients over years. So we're much less focused on what the impact of the next social media post might be. And we're really thinking about what are the impacts on the economy, on the industries, on the companies, on the earnings, and the valuation that you might apply to those earnings. So then let's think about energy. When the conflict started, correctly, there was an understanding that if this is short, we should look through it in terms of volatility and think about earnings. There was also a lot of commentary correctly pointing out that energy is a much less significant commodity economically and for consumers than it would have been in the 1970s, and also a much smaller part of the overall stock market. Now, that's correct. I think the conclusion that therefore you can completely ignore it is a little bit of a risky one, and I'll explain why. So energy is a business as usual input for households and also for industry. And it is not quickly and easily substitutable, which means most people, most industries are actual price takers on it. When we think about oil moving from the 70s up to the 80s, up to the 90s, up to the 100s, that means that you have industries, companies, individual managers everywhere now suddenly having to decide, do they have to put up prices? Can they put up prices? Because they now have a different competitive environment. Everywhere, the pressure is gradually upwards. And this is why the feedback mechanism that Marianne mentioned, if energy does start to cause ripple effects, multiple spikes in prices, it affects inflation. Inflation affects rates. Rates affect the cost of money and therefore growth. And that is incredibly important for the equity market. So I think what the market may be missing in this is, yes, assuming that if it's a short-term conflict, this is something that we can look through. The longer it goes on, the more hard work, going through all of the details, going through the industries needs to be done to understand what will be the real earnings shock in terms of the earnings power of different companies and also in some cases opportunities.
So the pressure really building on the system. Back to bond markets, Marianne, and the impact on for example, public spending, of high inflation, impact of higher bond yields? Where are you seeing that going?
Well, there's definitely an impact on public spending coming from more spending on defense, and energy autonomy debate is a very important one as well. You would have as well some measures taken to protect purchasing power in different countries as well. So this is a clear the direction of travel for public spending and deficits. We kind of know where it's going. I mean, the US has been quite clearly talking about $200 billion additional dollars for defense. In France, recently, the government talked about, €6 billion additional spending as well, which is required. So clearly, this is negative for deficits all over the place. So again, I think, for the long end of the curve, the government bond curve, this is clearly a more negative backdrop.
Could I add to that, Seb? This is an area where, from the equity perspective, we may have a variation in terms of potential impact. The drive towards self-sufficiency in multiple different parts of industry can actually be a positive for many parts of the equity market, including if it's backed by increased fiscal spending. Now, obviously, there's a trigger point where the higher rates, the long end of the bond curve can be negative in terms of equity valuations. But self-sufficiency, insofar as it spurs governments to look for energy that is not imported, that is more renewable or sustainable on the ground and therefore controllable, defense spending that is more localized, supply chains that are more protected and localized. That investment drive, generally speaking, is a positive backdrop for equities, and particularly can be a positive backdrop for a broadening out of equity markets, which has been an important topic in recent years.
So some interesting structural changes afoot. Niamh, are there any other longer term lessons for investors that have emerged from the conflict, do you think?
I think this one on self-sufficiency is key. I think the question of how we produce and source our energy is a really important one. We know from the 1970s that massive change was spurred by the oil crisis at that time, and that includes many things that you wouldn't automatically think are top of mind. It caused acceleration in the wind industry in Denmark, in nuclear in France, in the energy efficient manufacturing in Japan, where they're best in the world. Now, this has been continued on in many different countries, but in areas like Europe, it had stalled a little bit, and then it took a pickup again after the conflict in Ukraine. That can be spurred again, I would expect.
In terms of the way that investors are looking to construct portfolios, given in light of what's happened over the last couple of months, obviously there's been an enormous amount of conversation around diversification. My question to both of you, I suppose, at this stage is that really working at the moment, given not just how correlated bonds and equities have been, but a whole range of asset classes? Marion?
I mean, the good old, 60-40 portfolio has been challenged for a few years, right? Because we've seen more and more positive correlation between bonds and equity. Of course, it's still below 1, but since probably the COVID crisis, it's closer to 0.5. And actually, this is where we've seen more and more gold added to the portfolio as a true diversification effect. And as a matter of fact, gold has been dropping significantly in March. So indeed, has been quite strongly decorrelated from the bonds and the equity markets. I think there's still plenty of liquidity in the financial systems, which explain that we have this kind of positive correlation between bonds and equities. So I think we need to reassess these, diversification strategies. But it's fair to say that rates and credit have been behaving quite differently during that crisis, credit being much more correlated to equity markets, obviously, and rates have been actually proven to be much more volatile.
Niamh, from equities?
Within equities through 2025, we saw a big benefit from diversification. So the US leadership that you had seen in previous years, still a positive backdrop in terms of stock market performance, but many of the international and emerging markets led the way in terms of overall performance. Into 2026, we've also seen some broadening of the market, not in the very recent past, but prior to that, and also a big fanning out in terms of the sector performance. So you are getting benefit from diversification with that type of performance.
Neve, I'm interested because if we think about the market momentum that we saw last year, are you more or less confident in the future of the rally now than you were in early March?
The strongest underpinning for the equity market through the rest of 2026 is what we're seeing happening on earnings. We've not just seen earnings continue to steadily march, we've actually seen a positive inflection upwards. So in 2025, there was a period, particularly for the quarter after the Liberation Day tariffs, when analysts, investors everywhere had to digest what was, like an energy price shock is, an increasing cost basis as a result of tariffs increasing globally. But from that point, so around the middle of last year, earnings forecasts started to gradually tick up. What we're seeing through 2026, even with all of the news flow, the noise, the shocking headlines, is that earnings are continuing to climb and at an accelerating rate. So we're now looking at about 18% forward earnings growth, which means, surprisingly, given that we are talking about new highs quite recently, the valuation has actually fallen. So the US market is now on about 20 times forward earnings. As I mentioned, many of the international markets are now trading at exactly where they would have been historically, but we have stronger earnings growth. So that backdrop is really supportive.
As you say, it does seem like markets have regained a lot of their confidence. Is that narrative on earnings the primary driver of that, do you believe? And then also, I suppose, what asset pools and types of investors are following that narrative?
So maybe I'll answer the second question first. Through recent years, we've seen passive flows, obviously, and retail flows have been a very strong, steady support for the market over time. And they're very comfortable with narrower markets. They're very comfortable with investing in the Mag 7, and that support has always been there. Fundamental investors care about the earnings momentum and trajectory near term, but also very, very importantly about the longer term earnings and the sustainability of that earnings profile. Because when you're investing with a 5-year horizon, a 10-year horizon, you want to see the dividends come through, you want to see the cash flows come through, and that all depends on those earnings coming through. As we think about what has changed most recently in the earnings trajectory, the single biggest driver has been AI. And this is a topic that it is impossible to not focus on when we think about equities. Also, more broadly, I was interested to read recently that AI was the biggest driver of all-time highs in trade in the US and in China. Last year, it's one of the most important drivers of CapEx at the moment, and it is still one of the most important drivers of earnings.
Mm-hmm. Okay, we're going to come back to AI shortly. Marion, from a fixed income view, thinking again about that US diversification trade that Neve was talking about post-Liberation Day, also the weak dollar trade. What's your position at the moment now on that from a fixed income perspective?
Actually, it's been really interesting to see that during that crisis, we didn't have a flight to quality pattern that we usually have within those volatility episodes. But instead, we've had really a strengthening of the dollar. Which was, to be fair, relatively short-lived, because the dollar has now completely came back to the levels that we had before the beginning of March. So I was very, very pleased to see a lot of actions in the portfolios, like really removing those, short dollar trades or long EM local currency trades, which actually can suffer from a strengthening of the dollar. So I think, ultimately, we still have a view that we're still bearish on the dollar. And this is really something that we believe is going to continue. And we want to position the portfolios for that. It's really interesting to make a comparison with 2022, because during, if I'm correct, February and September 2022, the dollar appreciated by 15%, while this year it's been really short-lived. It's been a month and it's been only 5%. So it just shows you how quickly so far the markets have been digesting that volatility.
Marion mentions emerging markets. We all know that was a big sort of bullish trade at the beginning of the year. Where is that for you from an equities perspective? And of course, it's not just one homogenous mass EM. So maybe you can pick apart a bit about what you're seeing there.
Sure. I think we can look at EM in terms of new economy and old economy, if that's not already an old-fashioned way of splitting it. But by old economy, I mean specifically resources. And when I talk about the two big structural themes that can change the economic setup, the industrial setup, and therefore the earnings opportunity in different areas, EM looks really interesting on both. On the resources side, the need for build on the AI side, and the need for self-sufficiency from a national perspective. All of those mean that we will need more materials. Again, we mentioned before, more energy. And there are many parts of the world, particularly in emerging markets, where they will benefit directly from that. So I think on the resources side, you have a part of the market in EM that had headwinds for many years that now has tailwinds. Separately, though, EM also has extremely interesting exposure to what is happening on the AI side and on the data center side, and they are the suppliers. In spite of all of the news flow that suggests trade is collapsing, it really isn't. And you have all of the suppliers on the equipment side, on the materials side, that are benefiting from the huge capex boom that we have at the moment. In EM, what's particularly interesting is you have such a range of impacts, such a range of macro backdrops, such a range of economic profiles in different countries. So you have the opportunity for really good picking by investors, whether it is the regional exposures or the country exposures or indeed the company exposures. And we have really good management teams in many cases that are getting really high market share in parts of these supply chains that I was mentioning, which again our portfolio managers and research analysts will be watching closely.
One other place I just want to touch on quickly, Niamh, is Japan. That was also a very popular theme at the beginning of the year. Where does that stand at the moment?
Japan does not benefit on the resources and materials side. It's well understood, I believe, that Japan is a big importer, but at the same time, Japan is a country that bears resilience in mind at all points. So in terms of strategic reserves of energy, they have a longer a strategic reserve that will hold them steady for a longer period than many other countries. And as I mentioned before, across so many industries, they have thought about energy efficiency in a more profound way than many of their competing countries for quite a period of time. So that drove huge gains in areas like automation, which now stand them in really good stead, because AI, we often think of it in terms of the tools that we use on a desktop, on a laptop, on our phone. But actually, some of the most interesting gains on AI are where it interacts with the physical economy, and Japan is right there in the center of that. And many of the companies that are strong competitors and players there will benefit from that. So there are sector-specific areas of interest in Japan, but also the broader backdrop in terms of the fiscal and monetary environment and the valuations that are on offer make it interesting for us.
On that topic of resilience, Marion, 2023, 2024's talk about maturity walls, it evaporated, but is there default risk creeping back in now?
So if you look at what credit spreads are telling us and valuations at the moment, it's a bit similar to what Niamh was mentioning on the equity market. We're really back to the historical levels. It's actually really interesting to see that we haven't even been close to the levels of liberation days. in whether it's high yield in the US, whether it's investment grade. The ER00, for example, for European investment grade debt, widened to 96 basis points. It's really far from 125 that we had only a year ago for Liberation Day, and now back to the really historical tights. So what the markets are telling you is actually we are quite positive about, the corporate outlook, and, that correlates really well to what Niamh was mentioning on the earnings outlook. And there is a very positive view on credit fundamentals. And it's really important to see that the trend has been about deleveraging balance sheets all across the companies that we invest in, which is extremely supportive and positive for credit investors. So this is a trend that, keeps on going and keeps on, feeding this positive sentiment into the market.
Are there any other changes that investors need to see, do you think, before they perhaps allocate more significantly to fixed income?
I think the fact that rates have been repriced on the upside makes it even more attractive for investors to reposition on fixed income, because the all-in yields are actually higher. So as long as we do not deteriorate the macro outlook significantly in the next few months, I think this will really give renewed confidence for investors into fixed income, and in particular into credit markets. So I think people are still waiting to see whether we have a potentially, short resolution of that conflict, and how it impacts oil prices, how it impacts global trade. But I get the impression that, we haven't seen material outflows from fixed income, and we are expecting to see inflows and to see flows again into fixed income.
I must ask you also briefly about private credit, because obviously that's been generating some widespread concern amongst investors. Do you see that continuing to expand?
Well, there are definitely a number of articles, a number of interesting developments on the private credit front. We've seen a number of funds gating, and that is to say limiting really the potential redemptions of their funds from investors. I have to say that private credit was never meant to be liquid, never meant to be mark to market. But actually, they've been packaged over the past few years in evergreen strategies, semi-liquid strategies as well, which was kind of interfering in a way to public credit, because public credit was the asset class providing that extra liquidity that private credit does not provide. I personally see limited contagion to the public credit market from private credit. I think this is very much a US asset story. There is a lot less leverage in Europe. There are better quality of covenants as well in European credit markets, private credit markets. So in my opinion, this is an ongoing development. This is not going to stop tomorrow. And clearly some investors are marking down their exposures and cannot redeem what they would like to redeem. But in my opinion, contagion to the wider fixed income is very limited.
Okay, well, I want to come back to the topic of AI now, because as you said earlier, Niamh, it's a subject that permeates almost every conversation that investors are having at the moment. But let's start on the fixed income side. Marianne, is AI investing becoming more debt-driven?
80% of all AI-related financing markets are being done through the US investment grade market. So yes, clearly, this is becoming a debt story. But it's actually really interesting to look at the numbers, because the 5 key hyperscalers, they actually only represent 4% of the US investment grade index, while it does represent 20% of the S&P. So it's still really, really small in terms of, the percentage that it represents into the indices, but it's definitely growing. And so far, I have to say it's been really, really well absorbed. But bear in mind that those hyperscaler, 4 out of the 5 key players are above or at AA ratings. So very low dispersion. The books are really super well subscribed. So far, those deals are going really, really well.
And that scale of supply you mentioned, what effect will that have on yields, do you think?
I think there will be limited impact on all-in yields as long as, those spreads remain pretty stable. And we see issuers, whether it's in the high yield space or investment grade space, being very opportunistic when it gets to timing. So they need to have the timing of the issuance right. Mm-hmm. But I think once you've done that, it should be pretty well absorbed by the market participants.
And Niamh, of course, the key question here is about earnings, as you've already mentioned. Will they cover these investments, cover the cost of the debt?
There are a couple of angles to that, Seb. I think I would start by saying the hyperscalers that Marian mentioned, most of them are very, very cash generative mm-hmm. companies. So they're adding amounts of debt that relative to their operating cash flow look quite manageable. But obviously, I'll leave that to the experts on the fixed income to opine. On the earnings side specifically, again, we leverage our research team that looks at this question globally to get informed, current and forward-looking answers. The answer coming back is really clear. They're seeing really strong demand for these products right now. So if we think of this in terms of the overall progression of the products, the breakout moment was 2022, and then we saw waves of increased attractiveness of the models, whether that was because you had widespread consumer adoption, widespread enterprise adoption, then the increasing competition from multiple models being extremely usable. What we've seen in terms of breakout in 2026 is agentic AI and the increased need in terms of compute and tokens that has. It's really, really real. It's really, really tangible. And it's meaning that many companies across the whole supply chain are saying that actually demand is exceeding supply and pricing power is very strong. Now, that does not mean that the topic is without debate. And it also does not mean that everyone's a winner. This is another important pivot or change within 2026 compared to previous years. In previous years, it was a tide that was lifting all boats, not at the same rate, but generally speaking, it was a positive tide underneath. So for 2026, just year to date, right? Remember, we're only in April. It's more than a 40% gap in performance between the best performing tech sectors and the worst performing tech sectors. And that's because of a realization that there's a crossover point when these models, AI capability, actually starts to have profound negative economic implications as well as positive implications. So here again, our analyst team is key. They are looking through those that are being the winners this year, those that are being the losers this year, and trying to figure out where you have the mispricing, where you have the misunderstood earnings trajectory, and where, therefore, there's opportunity.
Wonderful. Well, that is all we have time for. So thank you very much, Niamh.
Thank you.
Thank you very much, Marian, for joining me today and sharing all your thoughts.
Thank you.
And you can find more on the topics we've discussed today on your local Fidelity website or at fidelityinternational.com. If you've enjoyed today's episode, please like, share and subscribe. The producers today were Patrick Graham and Rachel Reed, with production support from Alex Willcox and Connor Baillie. For now, from all of us at Fidelity, goodbye.